Well, we're all about to wrap up things here in New York for the Thanksgiving holiday, and we're doing so with the S&P 500 at yet another all-time closing high. Now, what could change that in the short term? Well, obviously Thursday's meeting of OPEC could be very important. The oil price continues to fall. But more broadly, if we look at it in the longer term context, it's a very difficult situation to call. My guest, Ben Inker from GMO, suggests that we're in one of two scenarios. Heaven isn't on the table. What he does suggest is that we have a choice between purgatory or hell. This is how he describes hell.
Hell scenario is a bad scenario for owners of assets that's never going to get any better. So it would be a situation where the permanent returns to stocks and bonds have fallen from historic levels. And that's what we really fear is the worst case scenario, so that would be a world where it's not that stocks are overpriced today or bonds are overpriced today, but just that as owners of stocks and bonds, you can't expect to get the kind of returns that we're historically used to getting from those asset classes.
Now that doesn't sound good, but frankly, purgatory doesn't sound much better.
A purgatory scenario would be one where the permanent returns to assets haven't changed. But we're in a temporary situation where, because of today's high valuations, and you can think of that most easily with regard to bonds, today the 10-year bond yield's only 2.3. That's not much more than inflation. If you need to get, let's say, 2% plus inflation for a government bond, that means the yield is going to have to go up. You're going to get a lousy return out of bonds today. But the good news is, once you're through that, once you've kind of expiated the sin of overvaluation, you're back to a normal level.
Now, just to be clear, for the next 2 or 3 years, it would actually be better to be in hell rather than be in purgatory and suffer as rates rise as the economy returns to normal.
So the issue, the somewhat counterintuitive thing about purgatory and hell is, if we're in purgatory, given where today's valuations are, we're overvalued. And overvalued assets should be expected to do poorly. If we're in a hell scenario where the permanent discount rates for these assets have fallen, then the assets aren't overpriced. It's just that they're permanently going to give a lower return. So over the next 2 or 3 years, you're better off if we're actually in hell than if we're in purgatory.
So, what should we do about this then? The problem is there are very few assets that do equally well whether we're in purgatory or hell.
There aren't a lot of things that are going to do well in both scenarios. Certainly, once you've decided you're going to own stocks, the good news is if you find the cheapest stocks you can find, they should be better in the purgatory scenario than the average stock. They should be better in the hell scenario than the average stock. But if you're in purgatory, stocks are not going to be so good. And if you're in purgatory, bonds aren't going to be so good.
So I suppose that's a good Thanksgiving message. As ever, spread your assets widely and remember that value, buying something for less than it's worth, will always be beneficial in the long run. Other than that, any of Americans who are lucky enough to have substantial holdings in the American stock market have a lot to be thankful for. The stock market at the moment, for reasons that continue to surprise many of us, continues to confer great bounty.